Akashwani. In the weekly program Current Affairs, we now bring you a discussion on stability and health of the Indian capital markets. The participants are Mithili Bhusnu-Marth, economic analyst, and Anubha Rohatgi, anchor.
Maithili, the Indian capital market has been scaling new heights recently, with both the indices, the Sensex and the Nifty, closing at record highs. Now, at a time when there is subdued economic growth in some of the major economies of the world, what, according to you, are the reasons for the resilience and the robustness of the Indian markets?
Well, part of the reason really is that the Indian economy's fundamentals are quite strong. If you've seen both in terms of growth as well in terms of future prospects, the Indian economy has done quite well. In fact, the NSO has just upgraded our economic growth, GDP growth for this financial year to 7.3%. And that's really good by almost any reckoning. We would perhaps be the fastest growing economy amongst all the major economies. But stock markets don't really often reflect the fundamentals, though they're supposed to. So another really important reason why we've been doing so well is that because our domestic investors have now turned to the stock market in a way that they never did in the past through systematic investment plans. We've seen huge inflows through the SIP route. We've also seen foreign inflows. So both these combined, it's basically the surplus of liquidity which the world still has not entirely withdrawn. Even though central markets have been on a tightening mode, there is a lot of liquidity sloshing around in the world. That, combined with the fact that the Indian economy is seen as an island of growth with good prospects, we are seeing a lot of money coming into the stock market. But as we've seen, it's not really always a one-way street as we've seen, Anubha. We've seen just recently on Thursday, the markets really crashed. So that isn't the nature of stock markets. Though the secular trend might be upwards, you will have ups and downs. And that is why stock market investment calls for a different kind of investor, a different kind of regulation, and an altogether different kind of mindset.
You've mentioned quite a few things. You've mentioned domestic investors, you've mentioned the FIIs, you've mentioned the volatility of the market. I will come to all that a little later in the program, but the next question that I want to ask you is that the past year, that is 2023, has been one of the best years in terms of performance for both Nifty 50 and the BSE Sensex, despite global uncertainties and geopolitical tensions. Can you share some of the highlights and milestones of the markets in this period?
Well, yes, we did see a bull run. As I said, it was not a continuous bull run, but overall there was definitely a bull run, which is why in 2023, it's estimated the Sensex went up by as much as 18% and the Nifty, which is basically 50 stocks, whereas the Sensex is 30, went up by 20%. Now, this is a remarkable increase when you see that, normal year, the increase is not so dramatic. So I think one of the main reasons, as I said, is because of the increase in liquidity all over. The fact that bank interest rates had not really increased in tandem with the higher inflation, and the fact that because we had a bull run, it's a bit of which leads, who leads what kind of thing. So since when the stock markets are doing well, you have more and more investors rushing to the stock market and more people putting in through systematic investment plans because they thought the stock market is only a one-way street. So far, in fact, their hope, their expectations have been realized by and large. But stock markets, as I said, are never a one-way street. It's always a long-term investor, with the term long being differently defined for different people. So yes, I think, as I said, the same fundamental reasons that I told you in the past have been the reason for this bull market. But how long will it continue? Because remember, markets do not exist in a vacuum. They have an underpinning in the economy. And this year, one of the biggest uncertainties in the market is not in the market at all. It's in the political sphere. We do have general elections coming up for the Lok Sabha, April, May. And depending on what kind of government we get, that will play big time on how the market reacts. Markets live and thrive on fear. If you have more people who are fearful, you will find more sellers. If you have more people who are hopeful, you will find the market rising. So stock markets, as I said, it's an interesting game, but at the end of the day, it's a game. You win sometimes, you lose sometimes.
Well, you've used this term, not a one-way street, quite a few times. And what we can interpret to mean volatility. Now, some analysts and market watchers have been, maintaining that valuations of Indian equities are unsustainable. And like you just said, we did see markets given to volatility, in the last few sessions itself. So do you agree with these voices about the valuations? And if the valuations are indeed unsustainable, how much correction do you foresee in the short term?
See, if I knew that, I would be a millionaire or a billionaire. Frankly, that is why markets always have the last laugh. I do not think there's any investor, including some of the really big names, who can claim that they've never made mistakes. So yes, I think markets, it is very difficult to kind of second guess the markets. So it is basically a question of when will the correction happen? Are the markets overvalued or is essentially a game of perceptions. So when we say markets are overvalued, it's also important to remember that markets not one homogeneous whole. Within the markets, you'll have, large caps, small caps, mid caps, and you will have individual shares within the, large cap or mid cap. So when you make a blank, when anybody, not you, I said when market analysts talk about markets being overpriced, markets being overvalued, typically they look at what is known as the PE ratio, the price to earnings per share ratio. And that can vary depending on which segment you're talking about, which share you're talking about. So the average is not a very good way to go by the stock market. So are markets overvalued? It's hard to say. Yes, they would appear. I'm using the word appear. Going by the past trend, if you see the way markets have run up, so they appear overvalued. But does that mean whoever thought that the Sensex would be in the mid 70s or, that kind of number, 70,000. So nobody ever imagined. In fact, when COVID happened, I'm looking at some numbers when I was coming on your program. So in February 2020, the Sensex was at 42,000. And in just 1 month, March 2020, it fell to 25,630, a 39% fall in just 40 days. But since then, we've seen the Indian economy is recovered. And then the markets have really shot up. So it's very difficult to say, are they overvalued or not? Yes, they appear. The word, as I said, is always appear because stock market valuations are always based on perceptions. Markets look ahead. They don't look back. So basically, when a person invests in the stock market, he or she is assuming that the market will go up further. So it's essentially you're trying to outguess the future, as it were. So since it is a question of perceptions, if a large enough number of people feel that the markets are going to go up, they will go up. So as I said, during COVID, what happened? Nothing fundamentally changed. And that was also outside the market. Companies were doing as well as before, but because COVID was such a huge setback, markets took fright. The 2008 crisis was another example. There, of course, it was purely financial reasons. Markets suddenly took fright because of developments in the US, and we saw a huge crash. So it's very difficult to say blanket. I'm sorry to give such a long answer because that's merely because I cannot say for sure, are they overvalued? I'd say yes, going by past trends, they appear overvalued taken as a whole. But there are segments which are perhaps not overvalued. So it's essentially for each investor to take a call depending on his or her own risk-taking appetite.
Right. So when we talk about the stability and the health of the capital market or the, in financial market, most people think in terms of large caps. But, you also mentioned the fact that, there are mid cap, there are small cap indices, and these two indices have done really well in the past 1 year. What do you attribute it to?
Well, I think part of the reason really is that, large caps have largely had their day is the feeling. Whereas the potential, because as I said, stock markets are always looking forward. How much better is tomorrow going to be vis-a-vis today? And there is a feeling, particularly in the case of, mid caps, that many of our mid caps have the potential to become large caps. But this potential has not yet been fully cashed in. Whereas the large caps have already it's been factored in. So this, I think, is really the hope because it's always a matter of hope. And when you look at financial stability and things like that, by and large, the Indian stock market has done reasonably well. We have a pretty good regulator. It's all very well. I know fingers have been pointed at the SEBI, the stock market regulator. And like all regulators everywhere in the world, not just in India, it has had its failures. So this is not to say it has absolutely no failures at all. But by and large, it has functioned well. And when we say a regulator functions well, we are not assessing it in terms of where the markets are. Because where the market is, whether it's at 60 or 70 or 80, has nothing to do with the regulator. The regulator's job is to see that the markets function according to certain rules, it is transparent, and there is no market manipulation, large-scale market manipulation. So by those criteria, SEBI has done quite well. Yes, there have been cases of insider trading in some cases, but that has, even as we've seen in the US, it's been very difficult for the SEC to completely, rule out or eliminate insider trading. And just recently, we saw none less than the Supreme Court give a clean chit, as it were, to SEBI in the case of the Hindenburg and Advani shares, where it said, well, SEBI is doing a good job. It doesn't see the need for an SIT or any kind of parliamentary oversight. And that, I think, has come as a shot for SEBI.
Now, one of the measures of the health and stability of any capital market is the behavior of foreign portfolio investors or FPIs. And now, by one estimate, in 2023, FPIs bought Indian equities worth 1.65 lakh crore rupees, which was the highest FPI inflow since 2020. Now, there was a period in the last year when we saw FPIs, taking their money out of the Indian markets, but then the trend reversed. So what is it about the India story that continues to attract FPIs? And do you see them staying invested in this year as well?
Well, as I said, the fundamental reason why the FPIs are rushing into India, and of course, there have been times when they rushed out also. And here I must point out that one of the biggest strengths of the market now is the fact that unlike, say, about 8 or 9 years ago, when FPIs either make or break the Indian market, if they exited, the markets collapsed. If they came in, the markets rose. We now have the domestic investor who, through the SIP route, has become a stabilizing force. It's a counter force to the FPIs. So FPIs are coming to India because they see promise in the Indian market. As I said, our growth has been pretty good. And we've managed, even though there are times like we are living in a world with huge geopolitical tensions, we have managed to navigate these choppy waters of geopolitical tensions between different power blocks reasonably well. So FPI see India as a market which is going to grow. The fact is also that they're really worried about earnings in the US. They're not very sure how the Fed will react to continued inflation, how long will they pursue tight monetary policy. And they've also seen the Indian rupee being reasonably stable. Of course, we have seen the rupee depreciate over a period of time, but by and large, our macro fundamentals are in pretty fine fettle. So that, I think, has been a huge saving grace as far as the foreign portfolio investors are concerned. And one thing to India's credit, unlike many other emerging markets, we have never defaulted on any of our external liabilities. There has never been any attempt to prevent foreigners from taking their money out. So as far as their transactions are concerned, foreign portfolio investors are free to bring in money into India, they're free to take it out. But as I said, the biggest factor, plus factor for us in India, is that now the foreign portfolio investors cannot really rule the market. The Indian domestic investor is there as a counterforce. And that, I think, has been the biggest saving grace for us. They can no longer dictate terms to India, because one must remember that foreign portfolio investors are ultimately also driven by geopolitical concerns. We saw that what happened to Russia in the case of when the Russia-Ukraine conflict happened, Russia was thrown out of SWIFT and the Western powers had their way of trying to isolate Russia. But today, for instance, even if foreign portfolio investors were to exit, they would not have the kind of impact on the stock market that they would have had maybe 5 years or 6 years ago. And that, I think, is very heartening for any investor in the Indian stock market.
Yeah, you of course mentioned the domestic investors, and there is also the domestic institutional investors who've been very, very active post-COVID in the financial market. So do you see this trend also to continue?
Well, financial investors, if we're looking at domestic investors coming through the SIP route and mutual funds, I would look at mutual funds as institutional investors. Definitely, to the extent that the domestic investors are reflected through the mutual fund route, certainly they will continue. As considers, when you look at the other institutional investors, they would be there definitely, but there are no mandatory obligations on these institutional investors, like say the insurance companies, pension funds, banks, that to invest in the stock market. There are compulsions on them on how much they need to invest in government securities. But as far as equity is concerned, there is no compulsion on them. By and large, they invest a relatively small portion. But other institutional investors, particularly mutual funds, are big-time investors. And you have the HNIs, and of course, you have from overseas, you do have, network, sovereign funds, etc., are investing over here. So institutional investment, I think, will continue simply because the institutional investor is always able to hang in for a longer time. Unlike a retail investor who takes fright easily, institutional investors know how to play the game and they can afford to sit it out. So that, I think, is the strength of the institutional investor, which is why institutional investors don't turn tail so easily as the domestic retail investor. But the domestic retail investor is also gaining maturity. And unlike in the past where we saw any collapse in the stock market, you would see domestic investors pulling out. That does not happen to the extent as before now.
Now, you mentioned, of course, the fact that thanks to domestic investors, Indian capital market is no longer regulated by the behavior of the FPIs. And, we saw that the number and this active participation of domestic investors increased manifold. In fact, we saw a phenomenal rise in the number of demat accounts during the COVID period, post-COVID as well. So how would you explain the domestic investors' behavior? Is it because of the stability and health of the Indian capital market? Or is it the other way around, that the Indian capital market, the stability and the health that we are seeing is because of the contribution of the domestic investors?
Well, I'm going to put it very well. It's a bit of both, chicken or eggs kind of situation. But the fact is, I think so far post-COVID, the Indian retail investor has not seen any dramatic fall in the stock market over a longer period of time. And that is why, in fact, he's been lulled perhaps into some kind of complacency, which is why there is this worry that, as I keep saying, the stock market is not a one-way street. Unlike in the case of investment in a fixed deposit, where you know that if you invest 100 rupees, you are going to get something like 100 plus, depending on the rate of interest that the bank offers you. Of course, if you exclude inflation, so we're not talking in real terms, but in monetary terms. In the case of the stock market, you could invest 100 and get much less, could get even zero. Your entire investment could be wiped out. But that kind of fall we have not witnessed in the Indian stock market in the recent post-COVID. As I said, there have been ups and downs, but nothing dramatic. Even though sharp falls have happened, we haven't seen that kind of dramatic learning lesson. And that is my worry, that the Indian retail investor is not a very mature, entirely mature. He's better than before. He doesn't take fright easily, but he's got used to the fact that if you invest in the stock market, you're going to make money. And that is not necessarily always true. So I think that is why there is some kind of, I hope there's not a very bitter lesson coming for the Indian stock market investor. But to the extent that he invests in mutual funds and there is an intermediary who perhaps knows more than the Indian retail investor, I wouldn't fear so much for him. What I do worry about is that now you have a lot of retail investors who are playing the derivative game. And that is where the danger is, because derivatives require very specialized knowledge. And that kind of knowledge the retail investor may not have. But greed is something that I think humans invariably succumb to. So that is, I think, they only learn when they burn their fingers.
Coming to the specific sectors, so which sectors so far have been instrumental in the bullish trend of the Indian capital market? And in which sectors do you see the potential for growth?
Well, financial markets have done quite well. So I think financials, because financial sector reflects the entire health of the economy. If the Indian economy is doing well, banking and finance will do well. So to that extent, I think since the Indian economy is expected to do well, as I said, the big elephant in the room is always the elections. So if you get post-elections, God forbid, something like an unstable coalition, then you would find a huge collapse in the stock market. But hopefully that will not happen. The stock market will continue to grow, provided we have some kind of a stable government. And as things stand, it's very difficult to second guess the Indian electorate. They have thrown up surprises in the past. But by and large, the expectation is that we will have stability, political stability. And to that extent, we will have economic stability and financial stability. And markets will continue to grow. So financial markets, I think sector players will continue to do well. Auto has done quite well. IT has, kind of seems to be plateauing out. It's done quite well. But if you look at things like pharma, these are some sunrise sectors which people never anticipated would do well. But post-COVID sectors like pharma have also done very well. So I think there are some sectors, and again, green energy, there are a lot of hopes, though there are some question marks over that. So I think there are a number of sectors where perhaps the Indian economy will continue to grow well. And to that extent, you will find investor interest.
Coming to the central bank, the Reserve Bank of India. Now, the Reserve Bank of India's focus has been, of course, to rein in the inflation, as has been the focus of all the central banks throughout the world. So how has the RBI's monetary policy impacted the capital market and investors' confidence?
When the RBI's primary target post the inflation targeting, change in the RBI's Act to make inflation targeting its prime mandate, the RBI has been targeting inflation. The band is between 2 and 6%, and the actual target being 4%. But what happened during the COVID time, because RBI did not want the economy to capsize, the RBI, like all other central banks, pumped in a huge amount of liquidity. And my personal view in this is that because the RBI was a little late in withdrawing this liquidity for fear of rocking the economic growth boat, there was a lot of surplus liquidity which went into stock market, partly because stock markets are doing well. You had retail investors coming through the SIP route. We had banks not giving you a very attractive rate of interest, particularly if you remember, inflation was very high. So there was a time when the real rate of interest, that is the nominal interest which the bank was giving you, less the inflation rate, was negative. So many people who were early putting money in fixed deposits moved towards the stock market. At the same time, banks also started lending unsecured lending, which is why Reserve Bank has recently cracked down on unsecured personal loans. So through a combination of factors, essentially loose liquidity, we have seen a lot of money coming into the stock market. So some of this money, as the RBI begins to tighten liquidity, as its banks start raising their rate of interest, you will find perhaps the flow into the stock market coming down a little bit. But I think by and large, the monetary policy, if they focus on getting inflation right, bringing it down, then growth will take off, because ultimately, if inflation goes very high, it will hurt growth. So ultimately, if the Indian economy is going to grow, you will find the stock markets doing well. So RBI's monetary policy, the present run, that bull run that we've been seeing post-COVID, has been essentially driven by liquidity. As liquidity tightens and interest rates rise, you might find some of the pace of that coming down. But as I said, for now, I think the biggest elephant in the room is the elections.
Coming to the, not just the RBI, whatever the US Fed, that is a US central bank, whatever they do, that also have an impact on the global economy, because it is the biggest economy in the world. So how are the policies of the US Fed crucial for the Indian capital market this year? Given that, even they are fighting inflation. Lately, we have seen that Jerome Powell and company, they have not raised the interest rates and they have an election coming as well.
Absolutely. They have an election coming too, but the US is a far more mature market. So to that extent, I think the Fed can take some liberties. And remember also that the US dollar is the international reserve currency. So the Fed has an enormous advantage. The US government has an enormous advantage that they can keep printing money and the whole world buys their dollars. So essentially, the US government's deficit is paid for by developing countries like ours. But the Fed's policy has a major impact because if the Fed continues to keep interest rates high, then other things remaining the same, what economists love to say, ceteris paribus, though in the real world, nothing really remains the same, but other things remaining the same, if US interest rates are high, then there will be a rush to safe havens. So you will find perhaps investors going back to the US because when an investor invests in India, there is the fact that despite all the promise of the Indian economy, if the rupee depreciates and for every dollar that he brings in, he'll be able to take out fewer dollars when he goes out. So when the US raises interest rates, there's that much less incentive for US investors to look elsewhere. So a lot depends on US interest rates. A lot depends on their liquidity also, because the Fed also had done what they call quantitative easing and flooded the world with liquidity. So that explains why we saw FPIs coming into India in a large way. So yes, the Fed is the numero uno central bank in the world. And what the Fed does matters enormously, not just for India, but for the entire world.
Now, the behavior of the markets also depends on the policies and measures of the government of the day. In that sense, how have the policies and initiatives of the central government contributed to the stability and health of the Indian capital market?
Well, the very fact that the government has, through its policies, essentially promoted growth, there's no doubt that the government has played a fairly mature role. For instance, if you look at the way they have kept fiscal prudence, we have not seen our fiscal deficit balloon. Yes, during the COVID years, it did go up. But after that, the finance minister has made a very concerted statement and effort to get fiscal deficit back under control. We have seen government borrowing increase, but not so dramatically. So government security yields, they have gone up beyond 7%, but they have not really shot up the way they have in our neighboring countries. So to that extent, the government's policies have been largely supportive of growth. That has certainly helped capital markets. At the same time, the government has also ensured that the regulators have a free hand. They are seen and allowed to operate independently. So that gives a lot of confidence to investors that here is a government which is supportive of growth, the economy is growing, the government allows the regulators to function independently and has largely kept its fiscal deficit, inflation, etc. under control. So prudent management, independent regulators, all these go a long way to reassure investors that here is a country where your money is safe.
In today's context, the world is a global economy where no economy is insulated. What challenges do you foresee for the Indian markets in this year?
The biggest challenge is, so leaving aside the elections, where I keep returning to because it is a big issue. I think the biggest challenge really is what happens as far as geopolitical tensions are concerned. If we see the problems in the Middle East and now the problems with Pakistan and Iran, if they spill over and we have a larger regional kind of conflict which drags in the larger parts of the world, and if as a result we see oil prices shoot up, then the Indian economy could be in serious trouble because the one commodity on which the Indian economy is crucially dependent is oil. We import close to 80% of our oil requirements. So what happens to oil prices have a crucial impact on the happiness, the health, the wealth of Indian investors, the Indian economy. So that I think the oil prices, the Fed's policy, geopolitical tensions, and the elections, these are factors I think that would impact the economy. Beyond that, I think we have fairly good management, macro management, both from the RBI as well as the government. So the risks are largely outside our control. And that is what makes it so worrisome. Because if these are risks that are beyond your control, then what do? You'll have to just sit and be a taker.
And coming to the retail investor, the domestic investors, what should they be mindful of while investing in Indian capital market in the year 2024?
Well, the first thing is don't be too greedy. You must remember that markets can rise, markets can fall. And you must only invest in the market to the extent to which you can take risk. If you want to be sure of your money, then put it in a bank. If you go to the stock market, you must be prepared that sometimes you may win, sometimes you may lose. So don't borrow and invest. Don't invest more than what you can afford to lose. And don't just think that markets can only go up. Markets go up, markets go down. I think every investor needs to see what is his time profile, what is his risk profile, what is his age. When you are young, you can afford to take risks. If you are in a job which pays you well and you're at the beginning of your earning life, you don't have too many responsibilities to your parents, children, etc., go ahead. You can take a lot of risk. As you grow older, your risk taking ability comes down. So I think this is a decision that each individual investor must take for himself, depending on his liquidity, depending on his needs, depending on his risk-taking profile, which of course is a function of his age and his commitments. So I think this is a decision for each investor to take, and must be taken with a great deal of thought and without too much of greed. Greed is necessary, because if there was no greed, we'd stay where we are and we would not try to improve our situation. But beyond a point, greed is bad.
Now, most major global economic organizations, including the IMF and the World Bank, are quite optimistic about Indian economy, calling it an island of stability, the bright spot in these times of economic uncertainty. Would you agree that the stability of the Indian capital market reflects this view?
The problem is that views keep changing. If you remember, not so long ago, we talked about India shining, and then suddenly it all came crashing down. So yes, today we are doing well. Yes, today the Indian economy seems very stable, and yes, things seem to be going in our favor. But that does not mean you close your eyes to the risks. Go into the market with eyes open. Things can change and can change dramatically. Whoever thought COVID would happen, right? So there's always a risk in any macroeconomic scenario, especially in terms of risks that are, as I said, outside your control. So remember that you need to go into the market with your eyes open and only take on as much risk as you can afford to take.
One last question. We were talking about the central bank. We were talking about the Reserve Bank of India and its monetary policy. The next meeting of the MPC is due in February. And though the Governor Shaktikanta Das just yesterday said that rate cuts, the central bank is not even looking at it right now. What is your view of the whole situation? When do you see the rate cuts happening?
Well, I do not think it will happen till late this year, calendar year, simply for the reason that the Reserve Bank of India is very seized with the problem of inflation. They want to see inflation down to 4% on a sustained basis. And the government will also be entirely sympathetic to this kind of argument, simply because inflation hurts any existing incumbent government at the hustings. So in an election year, governments are very wary of high inflation. So the RBI, not only because of its own mandate, but also because of an unstated support from the government to get inflation under control, would not want to take any risks by cutting interest rates. At the same time, growth is doing reasonably well, I would say very well. In fact, 7.3 this year. And even next financial year, it's expected that our growth will be over 6%. So growth clearly doesn't need that kind of support. So I do not see RBI cutting rates at all this year. Maybe at the end of the year, last quarter, that is September, December quarter, you would see. But as I said, everything depends on how other factors in the world play out.
Maithili, thank you so much for this very informative and insightful discussion.
Thank you so much. My pleasure.
You are listening to a discussion on stability and health of the Indian capital markets. The participants were Maithili Bhusnur-Marth, economic analyst, and Anubha Rohatgi, anchor. The program was produced and presented by the News Services Division of Akashvani. You can listen to it on your mobile app News on AIR. This program is also available on our YouTube channel News on AIR Official. You may share your feedback about this program through email at airnsdtalks@gmail.com or WhatsApp on 9289094044.